Let's assume that you are bearish about a particular stock. You think that the price is likely going to fall, but perhaps you don't think it's going to fall by all that much. One way that you could take advantage of this opinion is with a bear put spread. This is a strategy that will lower your overall risk, but at the expense of lowering your potential upside. Now, let's dive right into how this strategy works by first exploring the basics of a put option. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell an underlying asset at a predetermined price, which we'll call the strike price, on or before a specific date. If I buy a put option, I'm paying an upfront cost, which has the potential to pay me a lot of money should the stock price fall a lot. Now, let's look at the potential profit and loss payoffs that I could experience at the end of the life of my option. If we are feeling bearish, we might long or buy a put option with a strike price of $60. Now, this means that we will have the right to sell a stock to someone else for $60 regardless of what the stock price ends up being. That means that we would be more inclined to take on this position if we had a feeling that the stock price was going to fall. Now, the other party is taking on a substantial amount of risk in this contract should the price fall a lot. So in order to compensate them for the risk that they're taking on, we have to pay them an initial premium of $6 up front. So if we look at this table down here to the left, we can see all the various profits or losses that we might incur on this position at various stock prices. Now, starting at $0, this is our absolute best possible outcome because we can sell something that is worthless to this other party for $60. That represents a $60 gain for us. However, we had to pay them an initial premium of $6 to get that right, so those values will offset and our total profit will be $54. Then, if we go look at a situation where the stock price is $50, we are now selling something worth only $50 to someone else for $60. That represents a $10 gain to us. Then we have to subtract the initial $6 that we had paid them up front for a profit of $4. Where we will ultimately break even in this contract is when the stock price is $54, because our gain at expiration of $6 perfectly offsets the premium we initially paid of $6 for a profit of $0. And then once we get up to $60, there's no point in exercising this option. So its value to us in that max of strike price minus stock price or zero column is just $0. But we did pay the premium of $6. So we're out our initial $6 premium and we never made any of it back. And that is how our profit profile will remain no matter how high the price of this stock actually goes. So we have limited upside, but we also have limited downside when we long a put option. Now, what is a bear put spread? It is an options trading strategy that involves simultaneously buying a put option with a higher strike price and selling a put option with a lower strike price. Both of these options must be on the same underlying asset with the same expiration date. So these options will largely offset one another. Now, who would want to undertake a bear put spread? Well, someone with a moderately bearish outlook. Someone who thinks that, hey, maybe the price of this asset or stock is going to fall, but maybe not by all that much. They might also appeal to someone who is a bit more risk averse, because a bear put spread has limited risk, but that comes at the expense of limited profit potential. Now let's dive into how we could execute a bear put spread. Our first step is to purchase a put with a higher strike price. Now, we're going to use the exact same example as we talked about a few minutes ago. So we're going to assume that we are buying a put option with a strike price of $60, but we have to pay a $6 premium to lock in this contract. Now, this is going to have the exact same profit profile as what we had just discussed a few minutes ago. Our second step is to sell a put with a lower strike price. And so for this example, we'll assume that we're going to short a put with a strike price of $50. And when we sell it, we're getting a $3 premium. Now we can see the profit profile in that column of this table called short 50 put profit. And we can see that when the stock price is 0, that is our maximum loss, because the person who bought it from us, they can sell us something that has a value of $0 for $50. That represents a $50 loss to us. However, we did receive our $3 premium when we sold them that put option. So our total loss is just $47. And then for every single dollar that the stock price increases from there, we'll lose one less dollar until the stock price approaches $47. That would be our break-even point. And then once the stock price gets to $50, this put is no longer exercisable. So we will just keep our $3 premium and not have to pay anything to the other party. And so our max gain on this short put is the $3. And you can see this represented on that orange line over there. The bear put spread profit is just the combination of the gains and the losses on the two underlying options. And we can see this reflected in the column bear put spread profit on the table below. Now, we said that when the stock price was 0, that was the maximum we could gain on our long 60 put. We were up $54. It was also the maximum we could lose on our short 50 put, where we were down $47. Now, if we combine the payoffs of both of these, we actually end up with a $7 profit. And that will remain the case as long as both of these stocks or options are exercisable. So all the way up to $50, we're still up $7. However, once one of these puts becomes out of the money, like once the short put is out of the money, that's when the payoff profile begins to change. And that is what you are seeing between the prices of $52 and $60 on that graph. And our actual break-even point is when the stock price is $0. We're still up our $3 premium on our short put. However, we are down $3 on the long put position, and they exactly offset one another. And then the max we could ever lose is when the stock price is $60 and up. We are out our initial $6 premium on the long put, but we are up our $3 premium on the short put. Those perfectly offset one another, and we are just out a total of $3. Now, why would we prefer a bear put spread to just going long the put? Well, we can see that answer to that question in the price chart on the right, or the profit diagram. So wherever the green line is above the blue line, it would actually work out better to execute the bear put spread. So basically, any point from $47 and up, you perform slightly better with the bear put spread. So if you don't think the stock price is going to fall all that much, you would actually better off going with the bear put spread. However, if that stock price really fell, you would have made a lot more money off the long put. So this is why we say that the bear put spread has limited risk, because it lowers how much money you could lose compared to, say, a long put. However, it has limited profit potential as it caps your potential gain if the stock price were to continue to fall. That's why if, let's say, the stock price was like $53 and you only thought it was going to fall a little bit, you might prefer a bear put spread over just going long the original put. Thank you so much for watching my video all the way to the end. I do truly appreciate it, and please feel free to check out RyanO'ConnellFinance.com for any help with finance tutoring or financial modeling that you may need. And check out some of my other option videos here and here.